Well, good afternoon, everybody, and welcome to our end-of-day market review for November 17th, 2011. My name is Jason Waugh. I'm one of the trainers and success coaches here with Diligence Works. I'll be walking you through today's presentation. I'm just going to go ahead and jump into our agenda. You're going to see that we're going to cover a few things, first of which is daily news. There's actually not a ton out there today. Today was a technical analysis kind of day, definitely a day full of emotion. But we can take a look at a little bit. Now we're going to take a look at the market outlook, which is where we're going to be looking at the S&P 500 as well as the volatility indicator. Those two combined will give us a painted picture, and let us just see where we are in the big scheme of things from a technical standpoint. We'll be looking at the current watch list. Although we had a catastrophic day, there are a couple of symbols that showed up on our watch list. And we're just going to look to see if those are worth looking at, given the fact that the markets are declining. There was nothing from yesterday's watch list, so we're going to avoid that and conclude by just piecing all these puzzle pieces together. The news, the outlook, and the volatility indicator. So with that said, let me just go ahead and just jump right into Yahoo Finance. And basically, if we were to read this article in its entirety, it would say that Wall Street, or the North American markets, took a plunge. And there was not really any real rhyme or reason for that decline. Aside from the fact that it did decline, probably a lot of concern, ongoing frustration in the marketplace, and then it ended up going down and falling below a major support level. And once it broke down below that support level, it was just everybody jumping on the bandwagon type of deal. And when you see some people selling, more people sell. When you see a bunch of people selling, even more people sell, until eventually everybody's selling and they don't really know why. Classic example of emotional trading. Nevertheless, that's exactly what happened. And we're going to take this and go right into our chart, where we'll be looking at the S&P 500. So here you have it. You can see that it was resting at a key support level, and today it said sayonara. It's plunged right down below that support level. If we take a look at the previous cycle highs, you can see that it's kind of resting there, but it looks like it's even broken down below there as well. So we had a real bad day. It wasn't a good day at all. As expected, that same decline also caused our MACD to go down into bearish territory. So we're now looking at a declining bearish MACD. Declining bearish, we're below all of our major support levels that we were able to build up through the months of October and November, and we're potentially going to see another decline down to 1100. Who knows? Maybe only 1150, maybe just 1200. I can't really say for certain, but what we do know is anything and everything that happened that we were able to hold on to that was good throughout October is kind of now thrown off on the wayside. Not encouraging news at all. But this news does lend into our watch list, and we'll explain that in just a little bit. Before we do, let's go ahead and take a look at our volatility indicator, the VIX.X. All right. So we can see that this indicator is at 34.51, which is certainly above 30, which certainly continues to emphasize the fact that the markets are very volatile right now. With this volatility comes uncertainty. With that uncertainty, you're going to have days where the Dow Jones is down 134 points, or the S&P down 20 points, and people scratching their heads and going, why'd that happen? You're going to have days where it'll just go up, and no explanation for that. And this is what we expect when this indicator is above 30. It's just volatile times. So we know that any trading that we do is going to be short-lived. We know that any trading decisions that we make are going to be put onto the sidelines, and we're going to wait to see what happens the next morning. Opening news and futures are going to be the governing cause of us going ahead and continuing on with the trade or not. Individual company data is less important now than it is when the markets are stable. I'm not saying that they're not important. I'm just saying that they're less important. Right now, the global conditions, the fear and greed and the emotions are the major contributing factor. And you might look at that and go, hold on, we've always been taught as traders that we should not be emotional traders. We've always been taught that we should use technical analysis and whatnot to make our trading decisions. And absolutely, that still is true. But what we're doing is we're analyzing the traders out there. We're analyzing everybody else. And if we can see that everybody else is being emotional and everybody else is trading off of the seat of their pants, then we're going to trade accordingly. And we're going to take advantage of their weaknesses, prey off of their weaknesses there. So with that said, let's go ahead and take a look at our current watch list and see just why there's a couple of trading opportunities out there given what we have. Now, we're going to start with DOG. All right, so what we're looking at right now is an inverse ETF. Now, an inverse ETF is an ETF that works in the opposite direction of its underlying exchange. For this one, we've got one for the Dow Jones 30. So let's compare this very quickly. You can see that if I were to go to the Dow Jones, let me do that right now. Oops. So we got that. I want the S&P 500. All right. All right. Looking at the Dow Jones, you can see that we've had two down days, followed by what looked like a pretty good month. Now, when we compare that with the inverse ETF, you can see we've had 2 good days, followed by what looks to be pretty negative. And that's because this works in the complete opposite direction of the Dow Jones. And because the Dow Jones is now declining bearish, this is now rising, and this is starting to find some good trading opportunities. And the reason why this is important is because it's now opening up the opportunity for us to trade as the markets go through some turmoil. It's not exactly shorting, because we're actually going to physically buy shares in this ProShare ETF. But this ProShare ETF makes its money by shorting the market. So what this means at the end of the day is that if this meets our criteria, there's no earnings to look for because this is just an ETF. We're going to go ahead and we're going to see what the markets do the next day. If the next day things are pointing to a negative start, futures are down, there's negative news, we're actually going to be excited because we're going to see a trading opportunity where the DOG could go up in value. If there's any inclination or any sign that there's going to be a mediocre or even a good day tomorrow, then we're going to avoid trading this altogether. And that's going to go for these other symbols as well. PSQ is a short for the QQQ, which is a mirror for the NASDAQ. So same type of scenario with this one. And then finally, you've got RWM. I'll have to admit, I don't recall what this is. Okay, so for the Russell 500. So this goes complete opposite of the Russell 2000. So there you have it, inverse ETFs. A great opportunity for us to take advantage of the stalling and correcting market conditions. We're going to see what happens tomorrow morning. If news looks negative, futures look negative, and they're expected to go down, then we're going to look at this and say, hey, you know what? It looks like we're going to get an opportunity to trade. Anything that looks otherwise, though, positive, we're going to say no thanks, not going there, which actually pretty much wraps up today. There's really not a whole lot more to piece together. We can see that these symbols on our watch list are going to be completely dependent on tomorrow's opening news. It can change just like that because that volatility indicator is as high as it is. And the only reason why we're seeing these opportunities right now is because the markets as a whole have broken down below some key support levels. All right, so with that said, we're going to end this session, and we're going to see what we have for tomorrow. Hopefully we're going to be able to make some trades, even though the markets themselves aren't doing so hot. So we'll talk to you guys later. Have yourself